Hello and welcome back to our Insider interview series. I'm Dave Baxter and joining me today is Joe Bauernfreund, Investment Manager on the AVI Global Investment Trust. Joe, many thanks for joining me.
Thank you for having me.
So let's start with what the fund actually does. You have a bit of a value focus, a bit of an activist tendency, but take me through the four main areas in which you invest.
Yes, so the four areas that we invest in, broadly speaking, are family-controlled holding companies. They currently make up somewhere between 30 and 40% of the portfolio. We invest in other closed-end funds, and that makes up just under 30%. We've got a lot of investments in Japan, and they make up a little bit over 20% right now. And recently we've been adding to Korea, which has been a very exciting opportunity for us. And we currently have over 15% invested in Korea.
You mentioned those family-controlled companies. That's not really an area many funds focus on. So what is the appeal there? How do they differ from kind of other companies?
There are a number of features that really appeal to us. Firstly, many of these family-controlled holding companies own very high-quality businesses, and they invest with a very long-term perspective or horizon. And that accords and aligns with our own investment objectives. Secondly, of course, they trade very often at wide discounts to their net asset value. They're inefficiently valued by the market, and that's also appealing to us. And we think the market often gets the valuation wrong of these kind of companies because they're quite complex. Oftentimes, the assets that they own are unlisted, and so the valuation of them is less certain. There's less research, and sometimes there can be less liquidity. And all of those features give rise to an inefficiency which we seek to exploit.
You recently built this allocation in South Korea, which has clearly been a market doing extremely well. What's led you there, and what's the case for kind of focusing on that market still?
Well, Korea has been a cheap market for many years. It's been very unloved by both domestic investors and by foreign investors. A new president came into power last year, and he came into power on a platform to boost the value of the stock market. Back then, the Kospi was trading at around 2,500, and he proposed that he would get the value of the Kospi up to 5,000 within a few years. It actually just breached 5,000 last night.
Oh, wow.
Intraday. And the reason why he's so fixated on the stock market is really to do with trying to encourage investors, domestic investors, and particularly young investors, to generate wealth for themselves via the stock market, and to remove some of the impediments to investing in the stock market. Broadly speaking, there are a lot of chaebols, very wealthy families that control huge companies on the stock market, and they're seen to be running those companies in the interest of the families and not in the interest of minority shareholders. So as part of the proposals of the president to boost the performance of the stock exchange, he's introduced a series of measures, and they're a carrot and stick approach, and they've borrowed some aspects of that from the corporate governance reform experience in Japan over the last decade. And it's fair to say that they've probably analysed and studied what went on in Japan over the last 10 years and saw the positive results of that. So examples include proposals to force companies to cancel treasury shares, to limit the voting of shareholders to 3% regardless of how much they own when it comes to voting for independent directors or independent auditors. And some of the carrots that have been spoken about include some tax advantages to encourage companies to pay out higher dividends, which is good for the families, but it's also good for minority shareholders. And then finally, you mentioned that obviously the market has gone up a lot and how it stacks up today. The really interesting thing about many companies in Korea is the fantastic earnings growth that we're seeing coming through. There are some large companies. We own Samsung C&T, which is a holding company that owns Samsung Electronics and Samsung Biologics. So it's benefited from the very strong performance of Samsung Electronics, but Samsung Electronics continues to have very high prospective earnings growth. And there are other similar family-controlled holding companies that give us exposure to other industries that have got fantastic growth prospects. One example is HD Hyundai, which is exposed to shipbuilding. They're the leading manufacturer of environmentally friendly LNGs and the LNG carriers, I should say. And they've also going to win, we think, a number of US naval shipbuilding contracts, which will provide a strong order backlog and very visible earnings growth.
So it doesn't sound like you're kind of tapping into that AI excitement, which has partly been associated with the big rise of Samsung Electronics, but also SK Hynix, which is I suppose, a stock we all know.
That's right. So we have some exposure via Samsung Electronics. We don't own SK Hynix currently, but the other attraction of all these companies is they trade on very, very wide discounts. And the discounts there are 50, 60, 70% in some cases. And the government's measures are really designed to encourage ownership of the stock market, but also to encourage companies to do something about their valuations and about shareholder returns. So we've already seen discounts start to narrow. But when you can find fantastic businesses that are growing rapidly, that aren't valued excessively, and that are trading at 50% discounts, and you know that the government and the shareholders are going to be doing things in order to narrow that discount, that's quite an exciting prospect for us.
A part of the trust many of our viewers will be interested in is investment trusts. Discounts there are extremely widespread, but things can go wrong. So how do you gauge when a investment trust discount is actually an opportunity?
Yeah, it's a good question. There's certainly more to it than just simply looking at discounts and saying something is cheap. We're all, if you read all the books about investing, we hear about efficient stock markets. And a big feature of what we do is built around the idea that stock markets aren't always efficient. And in particular, where you've got areas of the stock market that are neglected or overlooked by investors, that creates an inefficiency. But the first question we always ask ourselves is that if something's on a discount, and if stock markets are efficient, then that discount is there for a good reason. It's probably a value trap, and perhaps that's a warning to stay away. So we try and think, what is the market missing? And is there an inefficiency there? So if you take, for example, in the investment trust space, when you have private equity trusts trading on very wide discounts, there's obviously a number of factors behind that. But one factor could be that investors are uncertain as to what the true NAV is. Yes, the company reports an NAV, but particularly at times of change, perhaps there's question marks about those discounts. And if we're able to build a case around the NAV being more robust perhaps than other investors might imagine it to be, then that's an inefficiency that we can exploit and take advantage of the discount.
How would you judge that in the private equity space? I mean, are you digging into the kind of underlying holdings and looking at some form of earnings growth, or where do you start?
It very much depends upon the structure of the trust. So within the private equity space, you have, broadly speaking, two types of investment trusts. You have fund of funds that are very largely diversified, hundreds of different funds, thousands of different underlying companies, and you can't realistically carry out valuation exercise. But there are indications that you can look for that support or challenge the reported NAVs. And the biggest example of that comes from the secondaries market. And you can see transactions that occur often for those very same underlying funds. And recently it's been the case that secondary transactions have been effected at around 5 to 10% discounts perhaps. So that lends some support to the official NAVs. And if you then find those trusts trading at 30% discounts, or as they were a year or so ago, probably closer to 40%, then there's an argument that that's particularly cheap and attractive.
And for context, secondaries are where, I suppose, private equity have existing assets and then people can kind of buy into them.
That's right.
Later on.
That's right. And then there are some private equity funds where they have more direct exposure to direct investment, specific companies. Oakley Capital would be an example of that. And there, you can build an argument or an investment case around the valuations of specific companies. And we look at both opportunities.
So you've already mentioned Oakley Capital, but I wanted to touch on a couple of other kind of prominent investment trusts in the fund. For very different beasts, we've got Chrysalis and we've got Cordiant Digital Infrastructure. What are your general rationales for each?
Well, we bought both Chrysalis and Cordiant in early 2024. And if you recall, that was shortly after interest rates started going up, growth markets sold off, and there was uncertainty about the valuations of their underlying assets. In the case of Chrysalis, a lot of exposure to high growth companies. Klarna is a big investment. Starling Bank is another big investment. And NAVs fell, discounts widened, investors hated it. And that was interesting to us. And in the case of Cordiant, there was a close peer, purportedly or supposedly, in a similar digital infrastructure industry, which suffered very sharp declines in valuation. That tarnished Cordiant's case, even though they were very, very different assets. And that allowed us to buy in on a very wide discount at a time when other investors were shunning it. But going back to Chrysalis, it was our argument at the time that shareholders were, or the market was overly penalizing the shares. There were signs that valuations were bottoming out and that the exit market in terms of corporate activity or potential IPOs was warming up, and the prospect of Chrysalis being able to monetize some of those assets at valuations that were possibly above where they were being carried at that time seemed realistic to us. And so we accumulated a large stake. We became the largest shareholder, roughly 18% of the shares. As you say, it's been our largest investment for a while now. And what we've seen is, in fact, that they have been able to monetize some assets. Klarna, I guess, is a case in point. There's talk about potential corporate activity at Starling Bank. And at the same time, the board have committed to returning capital as and when capital is received from disposals, which we think is very much the right thing to do.
Interestingly, Chrysalis has decided that it's kind of going to make no new investments for a while. It's going to focus on kind of maximizing value from its existing investments and returning capital to shareholders. How do you deal with that criticism from some investors that it's a missed opportunity, that the trust in its holdings have further to run, and that we should really kind of stick to our guns?
Well, very simply, the shares are trading at a 30% discount, more or less, today. And what that means is, if they were to receive cash of £1 when they sell an asset and they were to reinvest it, the market would immediately value that as 70 pence. So you're immediately suffering a discount, which is not good for shareholders. And secondly, if they were to take that £1 and buy those shares on a 30% discount, that would generate an immediate uplift to NAV by having bought your shares at a 30% discount. So I think from both sides of the argument, there's a very compelling case to be made to return that capital to shareholders rather than make new investments.
And what's been your kind of latest investment trust buy? And in terms of sectors, where are you eyeing up there?
Well, within the investment trust space, we haven't made any new investments in the last year. We've added to several of our existing investments. And it's probably 2024 when we invested in Cordiant and Chrysalis. That was the last time that we made big investments in the investment trust space.
Joe, many thanks for your time.
Thank you.
And thank you for watching. Do let us know what you think about this in the comments. And if you are a fan of this series, do hit the like button and hit the subscribe button. Thanks and take care.